following content is an update and technical analysis on the U.S. Treasury markets, and I will be deep diving into the 2-year, 5, 10, and 30-year yield based upon the daily interval where I'd mentioned on the 13th of September 2023, based in the 10-year yield technical analysis and stock market trade idea video, that it would be an ideal, great risk-reward ratio on a short trade setup for the 10-year bond based upon the 420 price support here on the 10-year yield, coinciding with the primary major price support level off the COVID crash lows, with just a ton of reaction right across that entire spectrum, where we briefly spiked up above, bonds ended up getting bidded, sunk below, right back up, retested the primary reactionary uptrend line, ended up having a snapback counter trend rally, consolidated briefly, tapped that 420 price support level once again, and we were honing in right back to it again, once again, providing a great risk reward ratio on a short trade setup for the 10-year. And days before the Fed meeting, where the economic data and the technical spectrum of the charts really told the story long before the rate decision presser. And it never ceases to amaze me how many times I've seen the charts absolutely manufacture the headlines. And here is the update. Coinciding with that primary reactionary uptrend line and the price support level, the entire trade was good for, call it a 7.3% crash to the downside. And I believe we are still in a critical stage throughout the entire bond market, where the 10-year is highly correlated to the mortgage markets and a supply-demand government bond issuance, where we could potentially revisit the primary reactionary downtrend line, end up having an additional reactionary low if and when met, which could be an add-on to your existing short trade position, if not once in hard objective short trade entry, an additional yield spike to the move to the upside, if and when we do not get the Fed manipulation and or breakdown in a heavy spiral for bidding in bonds, if the deflationary trade were to enact to the downside. But again, that is your key additional levels to watch if and to hone in on if we continue the onslaught of the bond market. I can only see these technical momentum indicators spiraling into even a much larger, healthier scale, whereas you have the oscillator completely bouncing around its zero line thresholds, being defended heavily for months on end here, whipsawing, and again, just going back since May, it has just been heavily defended as a great indicator on the technical dimensions for the 10-year yield. These are your key additional levels just to hone in on and to watch. Whereas bullish bond traders want to see a complete breakdown in this trend line for an additional heavy bidding on an all-out deflationary trade, versus the inflation trade of bear traders and or short sellers that want to continue to short bonds in general and continue the healthier swing in yields to the upside. These are your key additional levels to watch and hone in on. Taking you out to the 30-year, and it's been a while since I've updated the 30-year yield here off the daily interval, and I've added this new primary reactionary uptrend line, call it right off the mid-July reactionary lows here, and I believe this has been heavily validated with just a key technical reaction right across that sphere, if and when we go on to retest the 1 fibs retracement, call it the 458 price resistance, where it could spell for an extremely aggressive long trade entry on the long end of the curve for a retest of this primary reactionary uptrend line, which would spell a potential divergent high where we would conclude any potential divergence. We do have RSI negative divergence as of now, no oscillator divergence or moving average convergence divergence, but still something to keep an eye on, where the relative strength index indicator could act as an early indicator for the next transpiring move. Whereas bond traders, short sellers that are shorting the 30-year bond want to see a continued reaction amongst this trend line, completely taking out the 1 fibs retracement, where more carnage would be felt, where the yield curve has already been drastically inverted, which would only expel further damage and or bludgeoning of the stock market. Taking you to the 5-year yield, and we are across and broken, and we've popped this level, this key reactionary primary trading range and trading channel that was defended heavily for multi-years on end, and we've popped that level and really to the button based upon the 4.45 price support here, especially if you're an active and or day trader, really to the button. If you shorted on that single day, netted you 2.92% in gains, and then additionally the entire trade right as soon as we additionally pop that level has been good for a 4.5 crash to the downside in the 5-year bond, and yields are just exploding, breaking out of this primary trading range with only a potential for more carnage in the bond markets. Whereas you have the stochastics 1033 just really building strength and momentum, where we could see again just healthier technical momentum indicators just continue their move, where long traders, bull traders, they want to see a continued pullback in this yield, potential revisit, and that's where bear traders and or short sellers would need to defend the 445 price support, top of the primary trading range, really at all costs, to continue the momentum and the onslaught and the carnage within the bond in the belly of the curve. Taking you much zoomed into the 2-year, and this provides, in my opinion, an objective a short trade entry on the 2-year, coinciding with the 509. Call it an aggressive short trade setup. Call it big multi-year price resistance, which has now become some price support. We've had just a ton of reaction. Again, just spelling a great risk-reward ratio on a short trade setup with the 2-year. To further invert the yield curve, you have continued momentum in the stochastics 1033 indicator as well. Again, healthier indicators right across that sphere. And short sellers, bear traders want to see a continued reaction and a spike in yields, only putting much more pressure within the U.S. equity markets, only increasing the odds for a hard landing.